Let we start capital gain part 2. Now start with practice 4. Mr. Armugam sold the equity shares of ABS Limited for Rs 50 lakhs, which acquired by him during 2007 to 8, costing 2,80,000, and commission paid at 2% on both the transactions. Calculate taxable capital gain if cost inflation index for 2007 to 8 is 129 and for the year 21-22 is 317. And invested Rs 35 lakh in the new building for residents and 5 lakh invested in the equity shares of ACC Limited. Now, computation of taxable capital gain, equity shares of ABC Limited. Sale proceeds 50 lakh, less commission on sales 2%, so balance 49 lakh, less indexed cost of acquisition. For the year 2007 to 8, index is 129. The cost, actually, the purchase price was 2,80,000 into 2% is the commission, so into 1 or 2%. So the total cost will be, including brokerage paid on purchases, will be 2,85,600. We have to index that for the index 317. So the indexed cost will be 7,01,820. It was rounded off to 2 rupees nearest to rupees 10. So balance is long-term capital gain less we claimed exemption under section 54F because it is an equity shares. Shares is sold with the consideration. He invested the amount rupees 35 lakhs in the new residential house property, so we can claim exemption under section 54F. Amount invested in the new residential house is 35 lakhs into long-term capital gain by net proceeds. So the exemption amount will be 29,98,700. And he also invested rupees 5 lakh in the equity shares of ACC Limited. Actually, transfer of shares has no exemption. No exemption. Okay. In the same pattern, the students can do exercise 4 and verify the answers. Now, let we go for practice 5. Mr. Cashow purchased a shop in 2005 to 6 for Rs 60,000. Cost inflation index for that year is 117. And sold the same on August 2021 for Rs 8,60,000 and spent 10,000 as commission on sale of shop. Amount invested in another shop, Rs 3,50,000. Compute taxable capital gain. Let me see the answer. It's a commercial shop. Sale proceeds 8,60,000. Less commission on sales 10,000. The net concession is 8,50,000. Less indexed cost of acquisition because it is a long-term shop. He purchased it during 2005 to 6. In that year, index is 117. Actual cost is 60,000. Now we have to convert into indexation. So for the year 21-22, the index is 317. The indexed cost will be 1,62,560. So balance 687,440 with the taxable long-term capital gain. Note, we cannot claim exemption under section 54 for transfer of commercial building. Exemption under section 54 is applicable only for the residential building but not for the commercial. Okay. So in the pattern, everyone can do exercise 5 and verify the answer. Now let me go for practice 6. Compute taxable capital gain for 3 assets. Land, which is acquired in 95, cost 2,45,000, but the fair market value is 4,50,000. Whichever is higher, 4 lakh, the fair market value is higher, so we have to consider while computing the indexation. The fair market value as on 1/4/2001 only will be considered. And goodwill and tenancy rates. Actually, goodwill and tenancy rates, these assets may comes under the self-generated assets. The cost will be 0. And the tenancy rates, he paid 30,000, but we will not consider as a cost. So let me see the answer. First, land, goodwill and tenancy rights. Sale proceeds, land was sold for 48 lakhs, no commission on sales, so the net concession will be 48 lakh. Less indexed cost of acquisition for land. Actually, the land is purchased in 95, before 1/4/2001, so we have to consider the actual cost before 1/4/2001 or the fair market value as on 1/4/2001, whichever is higher. In that pattern, 4,50,000 is 2001 to 2, index 100. We have to index it for the year 2021 to 21. It will be 14,26,500. So balance 33,77,500 was taxable long-term capital gain for land. And for goodwill, the sales value is 5 lakh. It is self-generated asset, so cost will be 0. So entire 5 lakh be treated as a long-term capital asset. And for the tenancy rights, also the sales value 1 lakh. For the self-generated assets, cost will be 0, so the entire 1 lakh be treated as a long-term capital gain. cost price of the self-generated assets be nil. In the same pattern, everyone can solve exercise 6 and verify the answer. Now let me go for practice 7. Compute taxable capital gain for machinery and household furniture. Listen here carefully. Household furniture. Any household assets, items. These assets are excluded from the capital asset under section 2, subsection 14. So any household furniture was sold, we will ignore that one. Machinery, it is a business old property. For the business old property, we cannot claim indexation. Let me see the answer. Sales value in December 2021, 8 lakh 60. Cost of acquisition during 2016 for which 10 lakh, but the return down value on 1/4/2021 under section 50 class 2 is 7 lakh. So out of 10 lakh, we charge depreciation 3 lakhs, so balance 7 lakh is the return down value. So for the business old property, for the machinery, we have to compute the sale proceeds, less commission on sales nil, so balance 8 lakh 60 is the net concession, less cost. That means we have to consider only the return down value as on 1/4/2021. No need of the indexation for the business sold properties. So balance 1 lakh 60 is called short term capital. Why it is short term? Because we don't apply here the cost inflation index. So we have to put it as a short term capital gain. For the furniture, it is an household item, so it was exempted under section 2, subsection 14. Okay. Are you able to understand? The same pattern, everyone can practice exercise 7 and verify the answers. Now let me go for practice 8. Compute taxable gain. House purchased in 2004 to 5. Cost inflation index in the tier is 113. Cost is 2 lakh. Sold in December 21, 36 lakh. Purchased another property. So one property sold and the amount and the sale proceeds invested in another property, so we can claim exemption under section 54. And amount invested in the startups in shares in India in December 2021, 14 lakh. So here amount invested in the startups, so up to 50 lakhs was allowed to claim the exemption under section 54 EE under capital gain. Let me see the answer. House property, sales proceeds 36 lakh, expense on sales nothing, so net concession is 36 lakh. Less indexed cost. Actually, house property purchased in 2004 to 5, index is 113. What will be the indexed cost for the year 21-22 for 317? It will be 5 lakh 61,060. So balance is 30 lakh 38,940 is the long term capital gain. Here we can claim exemption under section 54. Transfer of residential house property. Actual cost of the new property is 10 lakh, or long-term capital gain is 30 lakh 38,940, whichever is least. 10 lakh is least. Balance less, we can claim exemption under section 54 EE. Investment in the shares of new startups or startups in India. The amount of exemption actual is 14 lakh, but the ceiling is 50 lakh, whichever is the least. 14 lakh is exempted. So balance 6 lakh 38,940 is taxable long-term capital gain. In the same pattern, everyone can practice exercise 8 and verify the answer. Now let me go for practice 9. Mr. Arun sold his household jewels for rupees 60 lakhs, which acquired by him during December 98 for 2,80,000. The fair market value as on 1/4/2001 being 6 lakh. So any cost before 1/4/2001 or fair market value as on 1/4/2000, whichever is higher, that highest amount will be considered for the indexed cost of acquisition. Commission paid at 2% on transfer. Calculate taxable capital gain if CAI for the year 2001 to 2 is 100 and for 2022 is 317. And invested is 40 lakh in the new building for residence and 20 lakhs invested in the new jewels for household. Investment in jewelry, we cannot claim exemption, but he sold jewelry with that sale value. He invested 40 lakh in the new building, new residence, so we can claim exemption under section 54F. Let's watch this. Household jewels. Sale proceeds 60 lakh, commission on sales 2%, that means 1,20,000. So balance 58 lakh 80 is a net consideration. Less indexed cost of acquisition. For the year 2001 to 2, index 100, cost is 6 lakh. So the indexed cost for the year 2021-22 of the index 317, the indexation will be 19 lakh and 2,000. Balance 39 lakh and 78,000 will be the long-term capital gain. Here we can claim exemption under section 54F. Amount invested in the new residential house. So actual investment into long-term capital gain by net proceeds. So 40 lakhs into 39 lakh 78 by 58 lakh 80,000. The amount of exemption will be 27 lakh 6,120. Balance 12 lakh 71 880 will be the taxable long-term capital gain. For transfer of jewels, no exemption. Now, in the same pattern, everyone can practice exercise 9 and verify the answer. Let me go for practice 10. Arun shifted his industrial undertaking from urban area to rural area on August 20 and sold the following assets of undertakings in September 2021. Net sale consideration for the plant and machine, both these were business old properties. Return on value as on 1/4/2021 is 10 lakh and 50,000. Cost of new asset purchase because it's a transfer of industrial undertaking from urban to rural area. So we can claim exemption under section 54G. Both these were business old property, plant and furniture. Net sale consideration rupees 30 lakh for plant and 4 lakh for furniture. Let's return down value as on 1/4/2001. That means cost price minus depreciation. 10 lakh for plant and 50,000 for the furniture. Balance 20 lakhs and 3,50,000 be the short-term capital gain, because we don't apply the cost inflation index, so this is called short-term. Let's exemption under section 54G, transfer of industrial undertaking from urban area to rural area. The new asset purchased 16 lakh of the plant and 3 lakh of the furniture, so we claimed exemption, so balance is taxable short-term capital gain. In the same pattern, everyone can practice exercise 10 and verify the answer. Now let me go for practice 11. Mr. Anbu sells the listed shares of A Limited during the previous year 2022. Sales value 4 lakh 50, year of acquisition 12 to 13. So the index was given there. Cost of acquisition 2 lakh 20. Invested rupees 2 lakh in the equity shares of Tata Chemicals Limited in June 2021. Compute taxable capital gain. Big year is sold the shares of A Limited and the sale proceeds were invested in another shares of Tata Chemicals Limited. So here it is a transfer of shares, so we cannot claim any exemption for transfer of shares. Let me go for the answer. Shares of A Limited. Sale proceeds 4,50,000, less brokerage in nil, so net concession is 4,50,000, less we can apply for indexed cost. For the year 2012 to 13, index 200, cost will be 2,20,000. What will be the indexation cost for the 2021-22 for 317? It will be 3,48,700. So balance 1,01,300 is taxable long-term capital gain. Investment in shares by sale of shares, no exemption under section capital gain. In the same pattern, everyone can practice exercise 11 and verify the answer. We'll see the comprehensive problems in the next video. Bye. Good luck to everyone.